In 2026, more than 600,000 Bitcoin, almost every coin mined since the last halving, has vanished from trading floors, absorbed by exchange-traded funds and locked in institutional custody. As market makers grapple with shrinking order books and miners face new pressure, the real power behind Bitcoin liquidity is shifting in ways few notice. But who truly controls the flow? And what happens when even small demand spikes trigger outsized moves? The answers start with what is quietly draining. Supply right now. 19,975,000 Bitcoin now exist. That is 95.12% of the total supply, with almost every coin that will ever circulate already mined. Each day, just 450 new Bitcoin enter the market, a pace set by the last halving in April 2024. Compared to traditional assets, Bitcoin's annual inflation rate stands at only 0.823%, well below gold's typical 1.5 to 2%. This extreme scarcity means even modest new demand can have an outsized impact on price. Glassnode. Data confirms that the vast majority of Bitcoin is now held in long-term wallets or locked away in institutional custody, leaving only a thin stream of fresh coins available for trading. With issuance so low and most supply already spoken for, the market's sensitivity to inflows or outflows has never been higher. Any shift in who holds or accumulates Bitcoin now ripples quickly through the price, setting the stage for new mechanisms of liquidity. Regulatory approval for in-kind creation and redemption arrived on July 30th, 2025, transforming how spot Bitcoin ETFs interact with the market. Now, when new ETF shares are created, authorized participants deliver Bitcoin directly to the ETF custodian, often in blocks of 20 to 500 Bitcoin, bypassing the need for cash settlement and reducing slippage. This pipeline draws supply out of active circulation with remarkable speed. Since the in-kind mechanism went live, ETF inflows have totaled 600,590 Bitcoin, according to issuer filings and on-chain proxies. That figure matches the entire net new supply since the 2024 halving, underscoring the scale of institutional absorption. Assets under management across all spot Bitcoin ETFs now stand at $564 billion. On-chain data from Glassnode shows large, labeled inbound transfers to custodian addresses on major creation days, providing a public record of these flows. As Bitcoin moves from exchanges into institutional custody, the visible trading supply shrinks, setting up a new dynamic for liquidity and price discovery. Authorized participants, such as Jane Street and Virtue Americas, now stand at the center of Bitcoin's supply channels. Acting as the primary bridge between ETF demand and the blockchain, these firms source large blocks of Bitcoin, often 20 to 500 Bitcoin at a time, transferring them directly into custodial cold storage. Custodians like Coinbase Custody and BitGo collectively hold more than 1.7 million Bitcoin, representing roughly 8.5% of all coins in existence. This inventory is not available for daily trading, effectively removing it from the open market. Chainalysis and Glassnode data confirm that these custody clusters have grown steadily since the in-kind mechanism approval in July 2025. The concentration is striking. Fewer than a dozen authorized participants and custodians now control a significant portion of non-exchange supply, making them the gatekeepers of available Bitcoin. Meanwhile, Glassnode's UTXO age bands chart a clear uptick in long-term whale accumulation beginning in late 2025, as large holders continue to sweep coins off liquid venues. These patterns reveal a supply landscape where institutional actors and whales dominate the available float, compressing liquidity and amplifying sensitivity to any future stress events. Exchange reserves have continued their downward slide, tracked daily by Glassnode's on-chain metrics. As more Bitcoin moves into ETF custody and long-term wallets, the amount left on major trading venues has fallen to multi-year lows. This contraction is not just theoretical, it shapes the reality of every large trade. Order book depth, measured by Kaiko as the total volume available within 1% of the mid-price, has thinned substantially across top exchanges. On February 1st, 2026, a sharp price drop to $78,000 triggered approximately $1 billion in liquidations, forcing market makers to pull back and leaving visible liquidity exposed. During that single day, Kaiko's depth metric registered a 28% decline, highlighting how quickly execution conditions can deteriorate when stress hits. With thinner books, even moderate orders can move the market, and slippage risk increases for both institutional and retail participants. The February event offered a clear snapshot. As reserves drain, the visible surface of Bitcoin's trading environment becomes more fragile and reactive. Market makers now rely on a complex set of hedging strategies to manage their exposure as order books thin out. CME futures and offshore perpetual swaps have become essential tools, allowing these firms to offset risk and maintain two-sided liquidity, even as visible spot depth declines. Open interest on CME has climbed, reflecting the scale of these hedges. Meanwhile, miners face a different pressure. With block rewards halved and operational costs rising, Glassnode data shows miners selling roughly 70% of their daily revenue just to cover expenses. This steady outflow adds a variable but persistent stream of new Bitcoin into the market, balancing institutional absorption with ongoing supply from mining operations. Exchange reserves respond sharply to ETF inflows. Using the reserves flow formula, a scenario with 10,000 Bitcoin monthly inflow predicts about a 10% contraction in order book depth. At 40,000 Bitcoin inflow, depth contracts by 33%, demonstrating the system's sensitivity to institutional demand. Liquidity power now sits with a handful of institutional gatekeepers. As transparency shrinks and access centralizes, every participant must rethink what trust in a decentralized system truly means. Join the discussion below.